Have you ever wanted to figure out how to invest in private equity companies that are able to generate a reasonable cash flow, yet also diversify against economic uncertainty? Well, Newlook Industrial Services Fund is an amazing opportunity for your portfolio. Check it out as we talk to Elroy Gust today. Hey, welcome back to Money Match. It's Ian Ardell here. I'm chatting with my guest here today, Elroy Gust, who is the CEO and founder of Newlook. Welcome to the program.
Thanks, Ian. It's great to be here. Thanks for having me on.
Elroy, tell me a little bit about who is Newlook and how long have you guys been around in business?
Sure. New Look is, I want to say, 20 to 25 finance professionals working in Burlington, Ontario. That's where our head office is. We've been operating since 2013. We brought our first fund to market in 2016. Roughly 500 million assets under management and working with both retail and institutional partners around two funds, our industrial and infrastructure services fund, which has been around since 2016. This is the third iteration. And our second fund, our dental practice roll-up fund, which has been in the market since 2018.
Thanks, Elroy. For the purposes of today, what I'd love to do is I just love to dive into our conversation around New Look Industrial Services Fund, and I'm wondering if you can maybe kind of give me the thrust of, what's its mandate and kind of how is it behaving in the marketplace?
Sure. No, good question. Our industrial and infrastructure services fund is really focused on acquiring, growing, and then potentially exiting businesses. When we buy them, they would have EBITDA of less than $10 million, so lower mid-market in the market space for sure. Really, we focus on essential service businesses that provide a technical service where that service that they provide is recurring. And for us, why we do that is resiliency in an economic downturn. Really, it's that essential service that has to be performed, whether markets are up or down, whether the economy's up or down. It's really that health and life safety business. One example would be a fire service business, fire safety business. Those would be some of the businesses that would fit into that mandate. Really, we work with existing management teams, so we always buy controlling interest, but usually we buy 60 or 70% of the business. We keep the management team in place. We like to grow with those experienced management teams that we have. And we've had a lot of success doing that. That was one of the first businesses we bought in 2013. We've had a number of exits along the way. Recently, we've had a couple of larger exits that have been very successful and showed that the thesis of the fund has withstood that now over a decade of being in place and has served our investors very well.
Yeah, if you think about that season of time, you've had, the energy crash, you've had, COVID, you've had now tariffs, and there's so many different market uncertainties, and yet you seem to have, you're still standing, so to speak.
Still standing and really we're still offering some pretty solid stabilized returns. And it's really built around the kind of revenue that we're pursuing. And these are smaller businesses, lower mid-market, but when you take them in bulk, it really gives you some mitigation around risk based on geography, risk based on business type. The total budgeted revenue for the fund would be around $230 million for the year, $30 million in EBITDA. So in aggregate, it's not a small business. It is a business that really, with that focus on recurring revenue, really allows investors to count on that cash distribution on a quarterly basis.
One of the terms that oftentimes are associated with your type of fund is called an evergreen fund. Can you just kind of explain to a novice investor, what does it mean to have an evergreen outlook or evergreen fund?
You know, why we came up with that was just learning from the first fund to the second fund, some of the challenges that we had in place just because of fund structure. And I think one of those is as we grow these businesses, as we do add-on acquisitions, and we have an artificial term that we have set for a windup of the fund, it may not always work with where the businesses are in their life cycle. And I think by having an evergreen fund, meaning that there's no set term for it to end, it really allows us to trade assets in and out of those funds based on, the best thing for our investors and the best thing for that business rather than coming up to an artificial 5-year term where we have to scramble to sell a business. It doesn't always work the best for the best outcome. And by having that evergreen, it gives us that optionality that if we feel a business has, more room to run and there's more room to grow, we're going to hang on to it. If we feel like a business has grown and we are seeing in the marketplace that we are able to get a multiple that would beyond what we could achieve internally, we're going to look at selling that asset and trading into another asset. So for us, that's been, a really big change structurally that I think is going to better serve investors going forward.
Well, and I think one of the other cool aspects that we're seeing is that not every investor is the same, and a lot of investors' suitability or their life circumstances changes. What might be a good idea here might be different 2, 3, 4 years down the road. And so, although Newlook is meant to be a long-term investment, aka 5+ years of investment time horizon, what I like about it is you guys have gone to updating your net asset value or your share price. How often is that updated now?
Yeah, so that is going to happen quarterly. And really, that's based on the work that we do with our internal valuation team alongside of our auditors. So we want to make sure that we're going to end up at the same place our auditors do at the end of the year. So there's a formula that we use in conjunction with their guidance and take a look at how the businesses have performed along the way. And we will make sure to try and reflect that as much as possible in the net asset value. Um, and we'll end up at the same place our auditors do at the end of the year. So the idea is in this iteration of the fund, it really is focused on income. It is an income generating fund, very tax efficient in how it does that. But alongside of that income generation, we do want to reflect the increase in the asset value so that investors can get some appreciation just around the increase in the value of the business as well. And, it's a fairly simple formula when you work it out. As we grow those businesses and as the EBITDA in those businesses grow, they're going to command a higher multiple in the marketplace. We've seen that over and over again. And I think that is going to be to the benefit of our investors in this iteration of the fund for sure.
So you've highlighted a couple of really neat things in there that I want to drill into. If somebody was getting invested today in your current Evergreen Fund or New Look Industrial Services Fund 3, what kind of, and again, no one can tell the future. No, like past performance doesn't guarantee future performance. But kind of, in terms of a modeling, what do you think is a reasonable expectation that an investor might have in terms of investing capital, and if they're dripping or compounding in their returns, what could they potentially anticipate in terms
I
of a
mean,
growth?
yeah, our targeted returns are going to be around that 8% mark. And we've shown over the number of years that that is achievable for sure with the businesses that we're buying and how we're growing them. There is going to be potential upside when we go to sell those businesses, and we've shown that there is some multiple appreciation as we grow those businesses. I think the key to that, the key to investor returns is probably at the new look level, where as we're entering our second decade of being in business, we have a group of young, dedicated professionals that have been with us through the first, second, and now third iteration, and they've done the hard work. So this is where those results that we've had over the last year are set up to be repeatable, where we have the people in place. There's a great culture, a confident culture, some younger, smart professionals that have been there to buy those businesses, to work with those business leaders to grow those businesses, and then to actually work through that sale process. And it's not easy. There is multiple people interested in these businesses when we take them to market. There's a whole legal process that happens around that, and the asset values, the enterprise values, when we take these to market, the last business we sold was an $80 million transaction. So having the people in place and having the management team in place at Newlook that has done that multiple times now, I think really sets us up for success. And we could see a repeat of those returns that we've had over the last year or two for sure.
Hey, thanks, Elroy. Um, just in terms of somebody, if they were taking income off of this strategy, I think, it works certainly well within a registered vehicle, but in a non-registered vehicle, oftentimes the conversation is around not so much what you earn, but also what you keep from an after-tax standpoint. And I think you guys have been able to structure very effectively. And so I'm wondering if you can just kind of talk me through the metrics of how that income is generated. First of all, if someone was to invest with those dollars, what is the income off of it, whether it's registered or unregistered? And then can you talk to me about the taxation structure, for an unregistered vehicle? So meaning, AKA, they're in unregistered dollars. How is that proceeds then being handled from a tax filing standpoint?
Ian, I have to start off by saying I'm not a tax professional, so I can give you my
Why
understanding.
not, Elroy? Why not? Yeah.
I can give you my understanding of how the tax works and in theory how it should work. These funds are set up to act as those distributions will act as return of capital. So, in theory, there's a certain amount of capital that's initially invested. We've taken distributions from those businesses or cash out of those businesses. And for the most part, that should be recognized as return of capital until the initial amount invested has been returned. In a fund structure, when you have a number of different assets, it can get tricky. So even as we exit one asset and all of the capital hasn't been returned, there could be a portion of that that would not be considered return of capital, would actually be a capital gain. So it's not interest income, I can tell you that. It is taxed as, if it is taxed, it's taxed as a capital gain. And leading up to that, there'll be a portion of it that will be considered return of capital,
And
hopefully.
what's the targeted percentage dollar for dollar like yield that's targeted?
So the yield portion, we buy businesses and structure those businesses, whether it's through agreements with our operating partners or just how and when we buy them around earnouts to make sure that our investors have 8% cash flow along the way. And then the targeted return, I mean, listen, we underwrite everything to a 20% return, IRR annually. We've done better than that in some cases, and we haven't achieved that in some cases. But because of the team that we have in place and the experience that they have, we've set it up to make that process and those outcomes as repeatable as possible.
I love ending with the question of why Newlook. Why should an investor today trust you with their capital inside Newlook and maybe more specifically Newlook Industrial?
Yeah, I mean, really, it's, that over a decade of being in these types of businesses now through, as you've said, economic downturns, a pandemic, could be a tariff, trade war now. We have guided these businesses. We've done add-on acquisitions to these businesses during that time, and probably the biggest reason was we have actually exited those businesses with some significant returns during all of that. So really, I mean, we're all only as good as our last deal, but I can tell you our last deals were pretty good, and you've got the same management team that's there repeating that success again.